All right, on today's show, we're going to talk about, can market volatility actually make you rich?
Aha.
All right, so
like
I
that.
think this is an interesting one because market volatility tends to bring out a lot of emotions in investors. People tend to act in ways that they know isn't in their best interest, but the fear or the panic or the equivalent that we use sometimes to pain when money's going down in value, we equate that to pain. All of those things can create a psyche that cause us to make irrational investment decisions, maybe because there's no data to support which route is best and which one is not. We have that data here today.
Yeah, and it just seems, Dan, that volatility has to be a bad thing, because it doesn't make us feel all warm and fuzzy when the market just goes up for a year. Maybe, we make a 22% return. It's like, man, this is what I need. This is what's really going to get me to the finish line. When in reality, it's those volatile times that really are the best years to helping you build money over a long period of time. So, like many things with money, what you kind of resist the most is often the most helpful. Wouldn't you agree?
I do agree. And so, again, it's not just an opinion. It can be fact.
It is.
The numbers don't lie, and we've got a little bit of a science project, right? My kids would go back and relate to this and go, okay, I see what you're doing here, Dad. And here's the basic math. Let me just walk you through a scenario. And what we've done here is we've created all of the scenarios to be the same, right? So that's the key to a scientific project. Everything has to be the same, and we're just changing one variable, and then we're going to see, does it produce a different outcome?
Yeah.
Okay, so that's the way it works. Here's the numbers. Here's the math. If you had $100,000 invested 20 years ago, okay, let's go back just 20 years, $100,000. And you put 100% of that in the S&P 500 index. So we're not doing anything crazy, just the S&P 500 index. Most people are familiar with that. $100,000, put it in the index, close your eyes, go to sleep, wake up 20 years later.
With gray in your hair.
With gray in your hair and 3 kids later.
Yeah.
8.9% would be your average rate of return. I think
almost 9.
That's
I'll
pretty
take
good.
it.
8.9%. Your $100,000 is now worth $547,000. That's you putting money in. Don't add another dollar. Let it sit there. 20 years, $547,000.
Yeah.
All right. This is where it gets exciting. Same $100,000 invested 20 years ago in the S&P 500. The variable we're going to change. What if you put $1,000 a month into that investment? So every month, regardless if it's going up or down, it's called dollar cost averaging, right? Every month we're creating a consistent investment strategy. So when the market's going up, we're adding money. When the market's going down, we're adding the same amount of money, okay? Everything's the same. My rate of return over that same time frame goes up to 10.26%. I increased my rate of return almost 1.5 points without adding any more risk to it over the same time frame, just by dollar cost averaging. Here's the most exciting part to me.
Drum roll?
That drum roll. 100,000 would have been 547 if we just invest 1,000 a month. That's $1.4 million. You've increased your investment $900,000 over that time frame. You increased your rate of return. Can market volatility, the ups and downs, make you rich? I think the numbers prove they absolutely can. But what's the key to this, right? The takeaway? Consistent investing through market ups and downs. We hear all the time, 2008, 2001 and 02, big market downturns. How many clients, Pete, did you talk to that came in and said, well, in 2008, I just stopped making contributions because all I was doing was seeing the market go down?
Yeah, absolutely. We want the pain to go away, and what we think is, I'm putting money into a black hole and it's gone.
Disappeared.
I put $1,000 in, it's down $2,000. So this can't be a good strategy to make money, and yet the very opposite being the truth. That is where the money's being made.
That's right. And some people call it even, I'm throwing good money at bad money.
Yes, I hear
No,
that.
you're not. You're buying more shares at the lower value. We all have heard buy
Same time.
low, right? Sell high, market's going down, buy low, continue to contribute even when it's painful on paper, because the end result can be substantial.
Yeah.
And so the way that you change your strategy would be continue to do the things you know you should do. Don't let the emotions drive the investments. Let the math tell you what to do, and it's here, it's fact, higher rate of return over the same time frame, and significantly more dollars.
Yeah, so dollar cost averaging, that works. Don't quit investing.
Yeah.
Don't quit putting money in. In fact, if there's a way, put more money in. So, and then another way, Dan, that we talk to people about, and we're talking to you about today, is buy the dips. If you have money set aside, maybe it's a good idea, not your emergency fund, you still need that for emergencies, but if you've got some extra money and you're just like, well, you know, when the right thing comes up, I want to do something with that, this is your time. This is the sign to say, hey, it's time to pull that money off the shelf that isn't really doing anything for you, and let's buy in when it's 10, 15, 20% or more down.
That's
Great
right.
opportunity.
Great way to make yourself rich, right?
Yes, that's right.
Use the volatility to be your friend. Well, I hope you enjoyed the show. If you want more episodes like this, click subscribe, or you can go to retirementtalk.com.